Imagine two people invest $10,000 today. They both believe they're making a smart financial decision. They both plan to leave the money alone for decades. And they both think they're investing in the exact same market. Fast forward 20 years. One portfolio has quietly compounded into serious wealth. The other barely kept up. No market crash, no scam, no bad luck. Just one decision they didn't even realize they were making. Because before you buy your first investment, there's a question almost nobody tells you to ask. Not, which stock should I buy? Not, is now the right time to invest? But something much simpler. What am I actually buying? Because if you've ever searched ETF versus index fund, mutual fund versus ETF. What is a hedge fund? You're not alone. Millions of Americans search those exact questions every year. And here's the problem. Most videos answer them one at a time. One video explains ETFs, another explains mutual funds, another explains index funds, another talks about hedge funds, but almost nobody explains how they all fit together. So beginners leave knowing 4 definitions without understanding the system, and that's dangerous. Because these aren't just different names. They're different ways of investing. Some are built for simplicity, some are built for flexibility, some are built for professional management, and one was never really designed for most everyday investors in the first place. So before you invest another dollar, let's build one simple mental model that makes all of this click. By the end of this video, you'll understand exactly what each one is, why millions of people confuse them, which one makes the most sense for most long-term beginners, and more importantly, why. The internet makes this worse. Search for investing online and you'll see the same questions everywhere. ETF versus index fund. ETF or mutual fund. Are ETFs safer? Should beginners buy index funds? What is a hedge fund? Then open YouTube. Thousands of videos, thousands of opinions. Some creators tell you to buy ETFs. Others swear by index funds. Some insist active managers can beat the market. Others tell you that's nearly impossible. Then someone mentions hedge funds, and suddenly it feels like you've entered an entirely different world. Private jets, Wall Street, billionaires, complicated charts. At that point, most beginners do exactly the same thing. They close the app and decide they'll invest later. But here's the truth. The investing world isn't actually complicated. It's just badly organized. Imagine trying to learn how a car works by watching one video about the steering wheel, another about the tires, another about the engine, without anyone ever showing you the whole car. Of course it feels confusing. That's exactly what's happening here. So instead of memorizing 4 separate definitions, we're going to build one mental model. Once you understand that model, everything else becomes obvious. Shh! The one idea that explains everything. Here's the biggest misconception beginners have. People think investing gives you hundreds of choices. It doesn't. At its core, every investment decision comes down to answering just 2 questions. Question number 1, who is choosing the investments? You or someone else? That's it. Either you're trusting a professional manager to decide which companies belong in your portfolio, or you're following a set of rules instead. Active or passive? Now, question number 2, how do you actually own those investments? Do you own them inside a mutual fund, inside an ETF, or through another structure entirely? And suddenly, those 4 confusing names stop competing with each other, they fall into place. Imagine a simple tree. At the top is investing. The first branch asks, who chooses the investments? On one side, active. Professional managers make the decisions. On the other, passive. A set of index rules decides what gets bought. Now the second layer, those investments still have to live somewhere. They can be held inside a mutual fund or inside an ETF. They're simply different containers. And then, off to the side, there are hedge funds. Highly specialized active funds built for a very different type of investor. Take a second and think about that, because this one idea explains why so many people get confused. Most people compare ETFs against index funds when they're not even answering the same question. It's like comparing a backpack to the clothes inside it. One describes how you carry something. The other describes what you're carrying. And once you understand that, the entire investing world becomes much easier to navigate. But now we've created another question. If professionals spend their entire careers researching companies, reading financial reports, meeting executives, using expensive software, and managing billions of dollars. Shouldn't they consistently beat a simple index fund? It sounds obvious. So why doesn't that happen more often? That's where our story goes next. The professional advantage. Let's say you wanted the best possible chance of making money in the stock market. Who would you trust? Yourself, or a team of professionals whose full-time job is finding great investments. Most people choose the professionals. And honestly, it sounds like the smarter decision. After all, they have research teams, financial models, access to company executives, years of experience. Some even manage billions of dollars. So here's the obvious question. If they're that good, why wouldn't everyone just let them invest for them? To answer that, we first need to understand what a mutual fund actually is. What a mutual fund really is. Forget the complicated definitions. Think about it like this. Imagine 100,000 people all put their money into one giant pool. Instead of each person trying to pick stocks on their own, they hire one professional manager. That manager decides, we're buying Apple, we're selling Tesla, we're adding Microsoft, we're reducing Nvidia. Everyone in the pool owns the same collection of investments. That's a mutual fund. It's called mutual because everyone shares ownership of the same portfolio. And on paper, it sounds fantastic. You don't need to research hundreds of companies. You don't need to read earnings reports. You don't need to worry about balancing your portfolio. Someone else does it for you. Of course, that expertise isn't free. Professional managers, research analysts, trading costs, office buildings, all of that costs money. And those costs are passed on to investors through something called an expense ratio. It's a yearly fee that comes out of your investment automatically. Sometimes it's very small, sometimes it's much higher. And here's the important part. You pay that fee whether the manager beats the market or not. Now, here's where the story takes an unexpected turn. If professional investors have more experience, more information, and more resources than the average person, why do so many investors keep leaving mutual funds for index funds? Shouldn't the experts be winning? The answer surprised even many professionals. The problem with trying to beat the market. Let's imagine the stock market is a giant basketball league. Every year, thousands of professional teams compete to outperform one another. Some win, some lose. But here's the catch. Every winner has to outperform someone else. Before costs, it's essentially a zero-sum game. Then add management fees, trading costs, taxes. Suddenly, the average active manager doesn't just have to beat the market. They have to beat it by enough to cover all those extra costs, and that's incredibly difficult to do consistently. Many active funds outperform in a single year. Some outperform for several years, but maintaining that advantage over decades is much harder. That's one reason many long-term investors have gradually shifted toward lower-cost index investing. So, if paying experts often doesn't guarantee better long-term results, what happens if you stop trying to beat the market altogether? The idea that changed investing. Imagine you and I make a bet. I tell you, I'm going to predict which 5 companies will dominate the next 20 years. You smile, and instead buy all 500 companies in the S&P 500. If one company fails, it barely matters. If another becomes the next Apple, you already own it. Instead of trying to guess the winners, you own almost all of them. That simple idea changed investing forever. This is the philosophy behind an index fund. Instead of paying someone to constantly ask, which stock should we buy next? An index fund simply follows an existing market index. No constant guessing. No expensive research teams trying to outsmart everyone else. Just a transparent set of rules. If the index changes, the fund changes. If the market grows over decades, your investment grows with it. And because there's far less buying, selling, and research involved, the costs are often much lower than many actively managed funds. That's one of the biggest reasons index funds became so popular with long-term investors. But here's the twist that confuses almost everyone. If index funds are so simple and so popular, why does everyone keep telling beginners to buy ETFs instead? Wait, aren't those the same thing, or are they completely different? The answer is yes, and also no. Let me show you why. The question that confuses almost everyone. Let's answer the question that confuses almost every beginner. Is an ETF An index fund? The answer is yes and no. I know, that sounds ridiculous, but in about 2 minutes it's going to make perfect sense. Because here's the mistake almost everyone makes. They're comparing two things that aren't even in the same category. One describes what you own. The other describes how you own it. Let me show you what I mean. Hash the bottle analogy. Imagine I hand you three bottles. One contains water, one contains orange juice, one contains coffee. Now imagine someone asks, which one is the bottle? That question doesn't make sense because they're all bottles. The difference is what's inside them. That's exactly how ETFs work. An ETF isn't an investment strategy, it's a container, a wrapper, a way of packaging investments. Inside that wrapper, you could own an index fund, or actively managed stocks, or bonds, or gold, or real estate, or even hundreds of companies from a single country. The ETF doesn't tell you what you're investing in, it tells you how the investment is packaged and traded. Now let's compare that to an index fund. An index fund isn't a container, it's an investment strategy. Its goal is simple: follow an index. Nothing more, nothing less. So now the answer finally makes sense. Can an ETF be an index fund? Absolutely. In fact, many of the world's most popular ETFs simply track indexes like the S&P 500 or the total stock market. But can an ETF also be something completely different? Yes. It could follow artificial intelligence companies, clean energy, healthcare, dividend stocks, treasury bonds, even a strategy that's actively managed. The wrapper stays the same. The contents change. That's why asking, should I buy an ETF or an index fund, is a bit like asking, should I drink from a bottle or drink water? One is the container, the other is what's inside. And once you understand that, almost every confusing finance headline suddenly makes sense. But now we've uncovered something even stranger. If ETFs are flexible, low cost, easy to buy, and index funds already solve one of the biggest investing challenges, then why do billionaires still pour money into hedge funds? Do they know something everyone else doesn't? Or is that another Wall Street myth? The billionaire myth. If Hollywood made an investing movie, this is probably what it would look like. Wall Street, trading floors, private jets, luxury offices, headlines about billionaire fund managers making massive bets, which creates a powerful assumption. If rich people use hedge funds, they must be the best investment, right? Actually, that's one of the biggest misconceptions in investing. Because hedge funds weren't created to make beginners rich. They were created to solve problems that most beginners don't even have. What a hedge fund actually does. Let's start with the name. Hedge. In finance, to hedge means to reduce or offset a particular risk. Imagine owning a beach house. You buy insurance, not because you expect a hurricane, but because you're protecting yourself if one happens. That's hedging. Many hedge funds work the same way. Except instead of protecting a house, they're managing financial risk. Some buy stocks while simultaneously betting against other stocks. Some use borrowed money to amplify positions. Some trade currencies. Some invest in distressed companies. Some try to profit whether markets go up or down. In other words, they're often trying to achieve very specific objectives, not simply beat the S&P 500. And because these strategies can be complex, hedge funds often charge much higher fees than typical index products. They may also have restrictions on who can invest, higher minimum investment amounts, or limits on when investors can withdraw their money. They're not designed to be the simplest path to long-term investing. They're designed for investors with very different goals, constraints, and resources. So why do the wealthy use them? This is where the internet gets the story wrong. Many wealthy investors don't use hedge funds because they expect magical returns. They use them because once you've already built substantial wealth, your priorities change. You're no longer asking only, how do I make more money? You're asking, how do I manage risk? How do I diversify beyond public stocks? How do I reduce the impact of large market swings on my overall portfolio? For some institutions and high net worth investors, certain hedge fund strategies can play a role in that broader plan. That doesn't automatically make them better, it makes them different. And that's an important distinction. Because if your goal is simply to start investing and build wealth over decades, you're solving a very different problem. Which brings us to the most important question in this entire video. Knowing everything we've covered, which one should a beginner actually choose? The decision framework. Let's forget all the complicated terminology for a moment. Imagine your best friend calls you and says, I finally have some money to invest. Before recommending anything, wouldn't you ask them a few questions first? Not, which ticker symbol do you want? But questions like, what's your goal? How long can you leave the money invested? How much risk are you comfortable with? Do you want to keep things simple? Or spend time researching investments? Because here's something the internet rarely tells you. There isn't one investment that's best for everyone. There's only an investment that's best for your situation. So let's simplify the decision. If your goal is trying to beat the market, you'll probably lean toward active management, where professionals attempt to outperform. If your goal is matching the market over the long run with lower costs, you're leaning toward index investing. If you want the flexibility to buy and sell throughout the trading day, an ETF may fit that preference. If you're comfortable with a traditional pooled investment that's priced once each trading day, a mutual fund may also work. And if you're managing millions of dollars, need specialized strategies, or have unique portfolio objectives, that's where certain hedge fund strategies might become relevant. Notice something? None of those answers came from hype. They came from asking the right questions. And that's exactly how experienced investors think. They don't start by asking, what's the hottest investment? They ask, what problem am I trying to solve? But if someone sat me down, gave me $10,000 and said, pretend I know absolutely nothing about investing, what would I tell them? Wahasha, what I would tell my younger self if I could go back and talk to my younger self. I wouldn't start by explaining candlestick charts, or options, or crypto, or trying to predict the next big stock. I'd start with one lesson. Don't confuse complexity with intelligence. Some of the best investment decisions are surprisingly boring. If you're a long-term investor, you have a stable income, an emergency fund, and you're investing money you won't need for many years. Then, for many beginners, a low-cost, broadly diversified index investment, whether it's structured as an index mutual fund or an index ETF, has historically been a simple and effective approach. Why? Because you're not betting on one company, you're not betting on one CEO, you're not betting on one industry. You're investing in hundreds of businesses at the same time. Some will fail, some will struggle, some may become the next Apple or Nvidia. You don't have to guess which ones. You already own them. And perhaps even more importantly, you're keeping costs low. That might sound boring, but over decades, small differences in annual fees can add up to significant differences in ending wealth because of compounding. That's why so many long-term investors pay close attention to costs. Not because fees look scary today, but because they quietly compound tomorrow. Does that mean index investing is perfect? No. Markets fall. There will be years when your portfolio loses value, sometimes significantly. That's the price investors pay for the opportunity to participate in long-term market growth. No investment removes risk completely. The goal isn't to eliminate risk, it's to understand the risks you're taking. The biggest lesson. Let's go back to the two people we met at the beginning. Same $10,000, same day, same stock market, but now you know something they didn't. The difference wasn't that one was smarter, or richer, or had insider information. The difference was that one understood what they were actually buying. One paid for complexity they didn't need. The other understood the system before making a decision. And that single difference, repeated over years, can completely change the outcome. That's why the real lesson of this video was never, ETFs are better, or mutual funds are bad, or hedge funds are only for billionaires. Those are oversimplifications. The real lesson is this. An ETF isn't automatically better than a mutual fund. An index fund isn't automatically better than active management. And a hedge fund isn't automatically smarter just because wealthy people use it. Each one was built to solve a different problem. Your job as an investor isn't to chase whatever sounds impressive. It's to understand the problem you're trying to solve. And choose the tool that matches it. Because once you understand the system, the jargon disappears. The confusion disappears. And investing becomes something much simpler than most people ever imagined. If this video helped untangle years of confusing finance advice, share it with someone who's been putting off investing because it all sounded too complicated. And if you want to understand how money really works, not just what to buy, but why, consider subscribing. Because the more you understand the system, the better your financial decisions become. The best investment decision begins with understanding.